picture this for a second. You've finally done it. You pulled the trigger. You've found that absolute perfect spot in Thailand. Maybe it's that pool villa in Phuket, the one overlooking the Andaman Sea.
Or a sleek condo in Bangkok for that sabbatical you've been promising yourself.
Exactly. The price is negotiated, the handshake is done, and in your head, you've already moved in. You're picking out curtains.
It's the dream scenario, right? It feels like the finish line after years of saving and planning.
Right. But here's the thing. Between that handshake and the moment the money actually leaves your bank account, the price of your dream house changes.
And not because the seller changed their mind.
No, I don't mean they called you up and raised the price. I mean, the house actually costs you more. Sometimes, significantly more than you agreed to pay.
Which is a complete nightmare. You've budgeted down to the last dollar,
Right.
You have your spreadsheets, and then suddenly there's a massive hole in the bucket.
Exactly. We're talking about the invisible price tag. We're talking about currency risk.
And I know what people are thinking when they hear that term.
Oh, yeah. Currency risk sounds like the title of a lecture you'd skip in college to go sleep on the quad.
It does. It sounds incredibly dry. It sounds like something for, day traders, not home buyers.
But the data suggests that ignoring this can cost you the price of a brand new car just in the time it takes to close a deal. So today we're doing a deep dive into the Thai baht.
Okay.
Why it moves, how it eats into your budget, and this is the key part, how to stop it from happening.
And we aren't just looking at generic Forex charts for this, right? Because theory is one thing, but, reality in Southeast Asia is often quite different.
No, and this is really important. We are basing this entire deep dive on insights directly from Ocean Worldwide.
Okay. The real estate agency.
Yes, they're a luxury real estate agency based right there in Phuket. And the reason that matters is their longevity. They've been operating since 2004.
Wow, 2004. So that
Yeah.
that puts things in perspective. That means they were there before the Asian tsunami, through the 2008 global financial crisis.
Through military coups, through the pandemic.
They have seen every flavor of volatility the economy can throw at an investor.
Every single one. And specifically, we're looking at advice from their director, Sandra O'Neill. She's guided thousands of families through this exact process over the last 2 decades.
So when we talk about strategy today, it's not theoretical.
Not at all. This is battle-tested, I sell villas for a living advice.
And that is crucial because currency risk isn't just lines on a graph. It's someone's retirement savings, evaporating because they didn't lock in a rate.
So let's get into the weeds. What actually is currency risk? I mean, we know exchange rates change, but give us the explain like I'm 5 version.
Sure.
Why should I care if the graph wiggles a little bit?
Okay. At its simplest, currency risk, or you'll hear it called foreign exchange risk, is just the possibility that you lose money. Not because the asset itself changed value, but because the money you used to buy it changed value.
Okay. So the house is the same price in battled, but my dollars or pounds just don't go as far.
Precisely. The source material uses a really great analogy to strip away all the finance jargon. Thai silk.
I saw this in the notes. I love a good analogy. Walk us through it.
Okay, so imagine you're on vacation in Chiang Mai. You find a stunning piece of hand-woven Thai silk. The price tag is 10,000 baht. You agree to buy it.
10,000 baht. Got it.
Now, let's say you're from the UK. If the exchange rate is 40 baht to 1 pound, that silk costs you exactly 250 pounds.
Simple math. 250 pounds. I hand over the card. I get the silk.
Right, but let's say you don't pay immediately. Maybe you order it to be custom-made and you agree to pay on pickup a month later.
Really?
In that short window, the Thai baht strengthens. It gets more popular. Now, the rate is 35 baht to the pound.
So my pound is weaker. It buys fewer baht.
Precisely. That same 10,000 baht price tag. It now costs you 286 pounds.
So that's, what, a 36-pound difference?
Almost 40 pounds, yeah. Just on a scarf. Now, 40 pounds is annoying. It's a nice dinner out. You'll survive.
Sure.
But the problem is when we stop talking about scarves and start talking about villas.
Right. You have to scale that up. Because nobody's buying a villa for 250 pounds.
Take a luxury villa priced at, say, 20 million baht. That same shift from 40 down to 35 doesn't cost you 40 pounds. It costs you roughly 72,000 pounds.
Whoa, wait.
Right.
That's a massive swing. That's almost $100,000 just gone.
Vanished. Into the ether of the foreign exchange market. Zeller didn't get an extra dime. They still got their 20 million baht. You just paid significantly more to get it.
That is terrifying. Because usually when we buy a house, we obsess over the negotiation, right?
Of course.
We fight for that 5% discount. We feel like geniuses when we get it. But you're saying the currency swing could wipe out that entire negotiation victory in, a week?
Easily. And often without the buyer even noticing until they look at their bank statement and realize they are way over budget. That's why Ocean Worldwide flags this as the #1 hidden cost.
Silent budget killer.
Exactly.
Okay, so if the bat is this volatile weapon that can destroy my budget, I need to know what makes it move. Is it just random chaos? Or are there, logic levers we can watch?
It's not random, but it is complex. Think of the Thai baht's value like a global popularity contest.
Popularity contest, like high school.
A little bit, yes. Investors are constantly moving trillions of dollars around the world looking for two things: safety and return. When Thailand looks like the cool kid, safe and profitable, everyone buys baht and the price goes up.
Okay, so what makes Thailand look cool? Or uncool?
It's a mix of global and local factors. First, you have what we could call the domino effect. This is the global stuff that has really nothing to do with Thailand directly.
Give me an example.
Think about the U.S. Federal Reserve or global oil prices. If the U.S. economy gets shaky or if there's a global recession looming, big investors get scared. They pull their money out of emerging markets like Thailand.
And run for cover.
And run back to safe havens like the U.S. dollar or the Swiss franc.
So if the world is panicked, they just dump the bat.
Generally, yes. When fear is high, people want the safest currency possible, which is usually the dollar. So the baht gets sold off and it gets weaker.
Okay.
But then you have the domestic factors, what's happening inside Thailand. And the big driver here is the Bank of Thailand.
Interest rates. I hear this on the news all the time.
It's the biggest lever they have. If the Bank of Thailand raises interest rates, suddenly keeping your money in a Thai bank pays a better return. That attracts foreign capital. Demand goes up. Baht gets stronger.
It's chasing the yield.
Always chasing the yield. If I can get 4% in Thailand and only 1% in Europe, I'm moving my money to Thailand. And then, of course, you have the basics: inflation and politics.
Politics feels like the wild card here,
Yeah.
especially in Southeast Asia.
It really is. Markets hate uncertainty more than anything else. If there are protests in Bangkok or a sudden military intervention, investors get skittish.
They sell.
They sell. The baht drops. Conversely, if things are stable and the government is announcing pro-business policies, the baht climbs.
So as a buyer, I'm basically at the mercy of the U.S. economy, the Thai central bank, and the local political climate all at once. That feels unmanageable.
It is a lot of moving parts. And because there are so many variables, the risk hits you in different ways depending on who you are.
Right.
Sandra and her team at Ocean Worldwide break this down into 3 flavors of risk, which I think is a really smart way to compartmentalize it so it's not so overwhelming.
Yeah, let's break those down. The first one was transaction risk.
Yeah.
This is the one we just talked about with the house purchase, right?
Yes, this is the time gap problem. In real estate, you almost never pay 100% of the cash on day one. You pay a deposit, then maybe progress payments if it's under construction.
Or a final closing payment months later.
Exactly. And every one of those future payments is a gamble.
Because you have a liability in the future in a foreign currency.
Correct. If the rate moves against you during that gap, you have a budget overrun. You effectively have to find more money to pay the same bill.
Okay. So flavor number 2, translation risk. This one seemed a bit more technical, more for the business owners listening.
Right. This is for people who might be running a company in Thailand or maybe have a branch office there. Let's say you own a UK company that opens a design studio in Bangkok.
Okay, so I'm earning baht in Bangkok.
The studio earns baht, it's profitable, it's doing great, but at the end of the year, you have to report your earnings to your UK shareholders in pounds. You have to translate the books.
I see where this is going. If the baht is weak,
Then your profits look smaller when you convert them to pounds. The business performed well, but the currency makes it look like it performed poorly. It's an accounting distortion, but it affects stock prices and bonuses.
that's frustrating. You do the work, but the math just makes you look bad. And the third one, economic risk.
This is the long game. This affects the actual cost of living and doing business in the country. It's the seesaw between importers and exporters.
Okay, break that down. Who wins and who loses?
If the baht is super strong, it's great for you if you're living there and buying imported wine or cheese. Your baht buys more foreign stuff.
Right.
But it kills the local exporters. If Thai rice or Thai cars become too expensive for the rest of the world to buy, the economy slows down.
So a strong baht isn't always good for Thailand.
No, not at all. It can actually trigger a slowdown. Conversely, a weak baht makes Thailand very cheap for tourists and buyers.
Yeah.
Great for us. But it drives up the cost of fuel and food for the locals.
It's a balancing act. But let's be selfish for a minute. If I'm the listener, I'm sitting here thinking, I just want to buy my villa and not get fleeced.
Fair enough.
The Ocean Worldwide team laid out 3 strategies to fight back. And I want to grill you on these because some of them sound a bit sophisticated for the average home buyer.
They can be, but the mindset is simple. You cannot control the market. You can't call up the Bank of Thailand, but you can control your exposure.
Strategy 1, forward contracts. The notes called this a time machine. How does this actually work? Do I just walk into a bank?
You typically use a specialist currency broker, not a standard high street bank. And here's the mechanics of it. You know you need to pay 10 million bahts in 6 months for your property closing.
Okay. And I'm scared the rate will get worse and cost me an extra $50,000.
Right. So you sign a forward contract today. You agree on a specific exchange rate now for that transfer that will happen in 6 months.
So even if the bat strengthens by like 20% next week, my rate is locked.
It's locked. You are immune to the market. You know exactly what it will cost you in your home currency. You send the agreed amount of pounds or dollars, and the broker delivers exactly 10 million baht.
But wait, what's the catch? Nothing is free in finance. What if the rate goes the other way?
That is the trade-off. It's the opportunity cost. If the rate moves in your favor, if the baht crashes and becomes super cheap, you don't get the benefit. You are locked in at the agreed rate.
So I could be sitting there watching the news, seeing the baht drop, and realizing I could have saved money if I hadn't signed the contract.
Yes. You might feel a pang of regret. But think about the alternative. This is insurance. You are paying or giving up potential upside to guarantee you don't have a disaster. For a life-changing purchase like a home, most experts, including Sandra, would argue that peace of mind is worth more than gambling.
Yeah, I'd rather sleep at night than gamble on a 10% swing. Okay, strategy 2. This one I found really interesting because it feels less like a financial product and more like a lifestyle choice.
Natural hedging.
This is the smart investor move. Natural hedging is simply matching your income currency to your expense currency.
Explain that in the context of the Phuket villa.
Okay. You buy the villa, that's an asset in baht. It also has liabilities in baht, cool cleaning, electricity, common area fees, taxes.
Right, the monthly nut.
If you're paying those bills by sending dollars over every month, you're constantly exposing yourself to the exchange rate. Every electric bill is a gamble.
So how do I hedge it? You rent the villa out when you aren't using it. You charge the rent in baht. Now, you have a pile of baht income sitting in a Thai bank account. You use that money to pay the pool cleaner and the electric bill.
So I never have to convert my dollars to pay the bills.
Exactly. You've created a closed loop. The asset pays for itself in its own currency.
I see.
If the baht gets strong, your maintenance costs go up in dollar terms, sure, but so does the value of your rental income. They cancel each other out.
That is brilliant. It turns the property from a money pit into a self-sustaining ecosystem. But I guess the risk there is occupancy. If nobody rents it, the hedge falls apart.
Correct. It requires the property to be marketable. But in a place like Phuket, with high tourism demand, it's a very viable strategy.
And the third strategy was just diversification.
The classic rule, don't hold all your wealth in one currency. If you're 100% in US dollars and the dollar tanks, you're in trouble.
Right.
Having assets in pounds, euros, and Thai baht spreads the risk. If one goes down, the others might hold you up.
So owning a Thai property is actually a form of diversification for your global portfolio.
It is. It's a hard asset in an emerging market currency. It balances out a portfolio that's heavy in stocks or bonds.
Now, I want to pivot to the logistics, because whenever we talk about moving millions of baht across borders, people get nervous. There are myths about money being stuck or the government freezing funds.
It's a very common fear, and frankly, the rules in Thailand can be bureaucratic. If you don't know the forms, you can get tangled up.
So let's bust the big myth first. Is it hard to bring money into Thailand?
No, not at all. Thailand wants your investment. You can bring in as much foreign currency as you want. There's practically no limit on inflow.
But there is a rule we need to know about, the $1 million rule.
Yes. If you bring in foreign currency equivalent to 1 million US dollars or more, you have to report it. And generally, you're required to convert it to baht or put it in a specific foreign currency deposit account within 360 days.
360 days, so basically a year. Why do they care?
Well, the Bank of Thailand monitors capital flows. They don't want massive amounts of foreign cash just floating around in the informal economy, potentially destabilizing the currency. They want it in the system.
Okay, bringing money in is easy. What about the scary part? Getting money out. Repatriation? Let's say I sell the villa 5 years later. Can I take my cash home?
Yes, you can.
Okay.
Thailand allows repatriation of investment funds, but, and this is a massive but, you need the paperwork. If you don't have the proof, the door stays shut.
What kind of paperwork? This seems like the part where people get tripped up.
So when you first send the money in to buy the condo or villa, the receiving bank in Thailand issues a form. It used to be called the Thor Tor 3, but now it's generally referred to as an FT form, a foreign exchange transaction form.
FA2 form, okay.
Do not lose this form. I cannot stress this enough. This piece of paper is your get-out-of-jail-free card. It proves that you brought foreign money into the country legally, specifically to buy property.
So when I go to sell,
When you sell the property and want to send the proceeds back to the UK or the US, the Thai bank will say, show us the FET form from 5 years ago. They need to match the outflow to the inflow.
what if I don't have it? If I threw it away with the junk bail?
You are in for a world of bureaucratic pain. You might be stuck paying taxes on it as if it were income earned in Thailand, or just facing massive delays while you try to dig up archival records from 5 years ago. It's a nightmare.
That is a pro tip right there. Keep the FET form in a fireproof safe. Staple it to the deed.
Absolutely. And Ocean Worldwide emphasizes this constantly to their clients. Their team basically holds the client's hand to ensure this form is filed and stored correctly. Get the paperwork right on day one, and the exit is smooth.
There was one other nuance in the notes about using foreign currency directly, not converting it.
Yes, this just creates efficiency. If you have a foreign currency account in Thailand, say in US dollars, and you need to pay a supplier in Singapore or a consultant on Hong Kong, you can often pay them directly from that account.
Without converting to baht first.
Right. If you convert USD to BAT and then BAT back to USD to pay someone, you lose money on the spread, the bank's fee, both times. Paying directly skips the conversion entirely.
That's just smart business. Stop paying the bank fees for no reason.
Exactly.
So we've covered the drivers of the bat, the risks, the hedging strategies, and the rules. It feels like the big takeaway here is just awareness.
Awareness is the first step. Currency risk is the silent price tag. If you don't see it, it hurts you. If you see it, you can manage it.
But I also think there's a lesson here about humility. We talked about forward contracts and FET2 forms, and honestly, if I were doing this alone, I'd probably mess it up. I'd lose the form.
You probably would. And that's not an insult, just that this is complex financial plumbing in a foreign jurisdiction.
Which brings us back to our source. This isn't the kind of thing you want to DIY based on a podcast episode.
No. You can understand the theory, but execution requires a guide. We mentioned Sandra O'Neill earlier. She's been doing this since 2004. Think about the volume of transactions Ocean Worldwide has handled.
They know which bank managers to call. They know which forms you need. They know the difference between a good rate and a rip-off rate.
Precisely. If you are serious about that Phuket dream, if you're actually looking at listings right now, do yourself a favor. Go to oceanwwp.com. Talk to Sandra and her team.
oceanwwp.com. Because you want the surprise to be how beautiful the sunset is, not how much the final wire transfer cost you.
Well said.
I want to leave you with a thought to mull over. We talked about natural hedging, renting out your property to cover costs. I want you to look at your whole investment portfolio. Is your real estate purely an expense, a sinkhole for cash, or can you structure it like that Thai villa to act as a shield?
It changes the way you look at ownership. It's not just a home, it's a financial instrument that works for you.
A financial instrument with an infinity pool, I can get on board with that.
The best kind.
Thanks for listening to this deep dive. Keep those finances hedged, and we'll catch you on the next one.
Goodbye, everyone.